Well, good morning, good afternoon, good evening, wherever you are in the world. I am Conrad Zen, former Bitcoin Foundation member and now evangelist for Pulse Zen. Slanjivar, everyone. Wow. I think everybody deserves a drink after this week of drama, especially in the crypto markets. It has been, to say the least, very exciting. Um, the first thing to note is why the heck are crypto prices crashing? Well, I can tell you, for one, that the interesting figure to look at is this, and I'll just try and show you if I can, because it is pretty actually interesting the amount of money that has actually been withdrawn from particularly the altcoin market. You can see here from this graph, if I can show you, we started off the year in alts at about 1.6 trillion. We're now down today to about 1.02 trillion, which means somewhere along the line, we have lost $600 billion of money from the markets. Now, that's bad, but then you have to understand the liquidation. Where is all that money gone? Does it just disappear? And the answer is no, categorically not. It doesn't just disappear. It's finally in the system, back in bank accounts and to other traders, etc., etc. The money just doesn't disappear. And so we can expect that amount of money and more to come back into the market. And we're predicting that we're going to see market capitalization of the altcoins of 15 trillion by the end of the year. Now, what do you think that is going to do to the influx of money and prices towards the end of this year? You know, when all the macroeconomics plays out. Well, with this loss of money, these liquidations, what has happened is not very encouraging, because if I show you here, that amount of money being lost has meant that the value of the core coins has actually gone down, and it's gone down a massive amount. I mean, look here, we've got Pulse at 329, down another 5% today. Hex is at 0.0817. It's down what? Oh, it is down a lot. I mean, this is not very good. I'll just wait for the airplane noise to disappear. All of us in Pulse Chain are quite disappointed at this. However, if we are actually going to look at the price of Pulse, then yeah, we'll take it. Up 40%. Where's that from? 40%. Um, okay, that is a massive move upwards over a particular long time span. But you can see that Pulse Chain by itself is only affected in the core coins. Why is that? I think you have to look at the greater picture. And that is, of course, that even before Pulse Chain was launched, Richard Hart had a very bad following of people, in that they just didn't like what he was doing. It was continually called a scam, and the project was called a scam, which, of course, the project itself is not a scam. Of course, when the judge dismissed the SEC case against Richard, I think we did right, and sort of like point out, although we're not lawyers, we did point out that he had uh, another 20 days to wait. And if that was going to be entertained, the SEC would still have extra time in which to present more evidence. Well, it turns out that, well, they haven't actually presented more evidence, certainly not to the public. but they're asking for another extension. That means at least another 50 days. And I think we wrote about this before, that this could be the case. This could be the situation. Now, I think it's highly unlikely that the judge is going to entertain their uh, case for extension by 30 days. It will then be completely dropped. But there's still FUD going around because there's still this Interpol red notice against Richard that hasn't been dismissed, that hasn't gone away. The biggest thing are the prices of the coins. Nobody's going to be interested in putting money into Pulse Chain Core coins when the prices are down so much, except if you have the belief that eventually the money's going to come rolling back in. But that could take some time. Right now, the only coin that's uh, getting any interest at all is Pulsen, and so it should, because it is one of the greatest protocols ever. But being a Bitcoin Foundation member gave me a front row seat to what happened. Could somebody put a one in the chat to make sure I'm not talking to myself and my next door neighbors? Somebody, anybody? A one in the chat to signify that you can actually hear my dulcet tones. Okay, still waiting. Does that mean that nobody can hear what I have to say? Something is going to be of interest to you, I'm sure, today. One in the chat from somebody to make sure you can hear me. Okay, thank you very much, Alt Season. I'll continue on. I was just saying that being a former Bitcoin Foundation member in Asia, I nearly headed it up uh, when they had the conference in Hong Kong, but I declined. One of the things that became very apparent just as I was joining, there was a horrendous debate going on about whether the block size should be increased. And it was evident that Satoshi Nakamoto, the group, had already planned for the block size to increase because he'd already worked out that unless we increased the block size, we were never going to do transactional payments through Bitcoin to the rest of the world. It would never be a payment system because it just wouldn't be able to hold enough data. The blocks would get full. The miners themselves were going to benefit because they could charge extra for actually processing the blocks. But of course, that meant that they were the winners and we lost. And so it was going to be a case that they were actually going to agree on a size increase. And they'll have you believe that they did by increasing it to 2 megabits. Well, they didn't. It wasn't really an increase to 2 megabits at all. Anyway, I won't go there. But what is interesting is what actually happened because the Bitcoin Foundation was actually set up originally to actually pay the developers because lo and behold, we only had a few developers anyway, and they weren't even being paid for what they were doing. So everybody felt that was very unfair. They should be all on side, and we should pay them through the Bitcoin Foundation. And that's how it all came about. It was a funding system for them. Not many people know, but about in 2012, the foundation became bankrupt itself. Anyway, that's a story for another day. But I think it's very interesting to see what is actually happening with the world of Bitcoin, because even though that we have now a strategic reserve in America, more to follow, I think it's pretty interesting to see exactly who owns the Bitcoin at the moment. Because if you follow the money, I think you'll see that the top government Bitcoin holders are in this order. The UAE, not verified, has got 420,000 Bitcoin. At the present prices, about 34 billion. That the United States has 198,000 Bitcoin. That is not anywhere near what the UAE has. China itself has 194,000 Bitcoin, followed by the United Kingdom, Ukraine, Bhutan, El Salvador, blah, blah, blah. So what that means is that even though the United States has created this Bitcoin reserve, it's only from the Bitcoins that they've currently owned. The UAE has nearly twice as much as the United States. This is incredible. So are we going to see $1 million Bitcoin? I don't think we're going to ever reach anywhere near that level. I mean, look, if you buy Bitcoin right now at, what is it, $85,000 or something, it means that just to double your money, we've got to have a Bitcoin worth $170,000. Who is buying? Because even Michael Saylor, who has actually been one of the biggest buyers of Bitcoin, he's running out of money. And the liquidation event risk for him is now exponential because it's quite clear what Donald Trump is doing, and that doesn't include bolstering the price of Bitcoin. I want to show you something if I can. We've gathered some facts and figures of the macroeconomics of, what's been happening in America. And the behind the scenes facts are pretty interesting. Let me just try and play this for you so you can see exactly what Donald Trump is up to and why.
The year is 2025. Donald Trump, after a tumultuous 4 years out of office, has returned to the White House. His second act as president began with promises of economic rejuvenation and American strength. However, the global landscape has shifted since his departure. The COVID-19 pandemic's economic aftershocks linger, and geopolitical tensions simmer. Trump's re-election campaign capitalized on economic anxieties, promising a return to prosperity. His victory speech echoed familiar themes: protectionist trade policies, deregulation, and energy independence. These pronouncements, while popular with his base, sent ripples of uncertainty through global markets. Investors braced themselves for a new era of Trumpian economics, a blend of unpredictability and aggressive policy shifts. The initial market reaction was mixed. Some sectors, buoyed by promises of deregulation, saw short-lived rallies. However, the specter of trade wars and protectionism loomed large. The business world, accustomed to globalization, viewed Trump's America First rhetoric with apprehension. The world watched with bated breath as Trump settled back into the Oval Office. The question on everyone's mind was clear: would this time be different? Would Trump's economic playbook, once a source of disruption, now bring stability, or would it exacerbate existing anxieties and usher in a period of prolonged economic turbulence? As Trump's policies began to take shape, a clear trend emerged in the financial markets: a flight to safety. Investors, spooked by the potential for trade wars and economic instability, sought refuge in traditional safe haven assets. Among these, gold shone brightest, its price soaring to unprecedented heights. The price of gold, a barometer of investor fear and uncertainty, had been steadily climbing in the years leading up to Trump's return. However, his re-election ignited a buying frenzy, propelling the precious metal past the psychological barrier of $3,000 per ounce. This surge was fueled by a confluence of factors, all stemming from Trump's policy pronouncements. Investor behavior played a significant role in gold's ascent. Market participants, anticipating inflationary pressures and a weakening dollar due to Trump's policies, sought to hedge their bets. Gold, with its historical resilience against inflation and currency fluctuations, became the go-to asset. This demand was further amplified by geopolitical uncertainties, with investors fearing the potential for global trade disruptions. The surge in gold prices wasn't merely a speculative bubble, it reflected a fundamental shift in investor sentiment. The global economy, already grappling with the lingering effects of the pandemic, faced renewed uncertainty under Trump's leadership. Gold, once seen as a relic of a bygone era, was back in vogue, a testament to the anxieties of a world grappling with political and economic instability. In contrast to gold's steady climb, The stock market resembled a roller coaster, experiencing dramatic swings in response to Trump's pronouncements and policy decisions. The initial euphoria that greeted his re-election quickly dissipated, replaced by a more cautious and often fearful sentiment. Trump's first term was marked by a bull market, fueled in part by his corporate tax cuts. However, his second term began against a backdrop of heightened uncertainty. His protectionist trade policies, a hallmark of his first administration, threatened to reignite trade wars and disrupt global supply chains. This uncertainty led to increased volatility, with the market reacting sharply to every tweet, statement, and policy announcement. Certain sectors were hit harder than others. Tech stocks, which had thrived during the pandemic, experienced a significant pullback. Trump's rhetoric on China, coupled with his administration's scrutiny of big tech companies, created a climate of uncertainty for the sector. The prospect of increased regulation and trade tensions weighed heavily on investor sentiment. The stock market's volatility wasn't merely a reflection of investor anxiety, it also signaled a deeper concern about the direction of the economy under Trump's leadership. The president's penchant for unpredictability and his willingness to upend established norms made it difficult for businesses to plan for the future. This uncertainty, coupled with the potential for damaging trade wars, cast a long shadow over the stock market. The cryptocurrency market, known for its volatility and speculative nature, offered a fascinating microcosm of the broader economic anxieties during Trump's second term. Bitcoin, the flagship cryptocurrency, became a focal point, its price fluctuating wildly in response to Trump's actions and pronouncements. Initially, Bitcoin seemed to benefit from Trump's return. His administration's signaling of a more open approach to digital assets, including the establishment of a crypto strategic reserve, sparked a rally in the cryptocurrency market. Bitcoin briefly surged past $90,000, its highest level in months, as investors interpreted these moves as tacit approval from the White House. However, this optimism proved short-lived. As details of Trump's crypto policies emerged, the initial enthusiasm waned. The proposed reserve, funded primarily by seized assets, was seen by some as a symbolic gesture rather than a substantial policy shift. Furthermore, the lack of clarity surrounding regulations and the potential for increased government oversight tempered the initial bullishness. Despite the volatility, Trump's second term marked a turning point in the relationship between the US government and the crypto industry. The establishment of a dedicated crypto task force and the administration's willingness to engage with industry leaders signaled a departure from the previous hands-off approach. Beyond the fluctuations in specific asset classes, the broader economic indicators painted a mixed and often confusing picture of the US economy under Trump's second term. While some metrics showed resilience, others pointed towards a slowdown, leaving economists and analysts struggling to make sense of the conflicting signals. Inflation, a persistent concern in the wake of the pandemic, remained stubbornly high. Trump's trade policies, which led to increased tariffs on imported goods, contributed to rising prices. The Consumer Price Index continued to climb, eroding consumer purchasing power and fueling anxieties about a potential wage price spiral. The labor market, a key indicator of economic health, showed signs of both strength and weakness. While the unemployment rate remained relatively low, job growth slowed from its post-pandemic highs. The manufacturing sector, a focus of Trump's economic agenda, experienced job losses due to trade tensions and supply chain disruptions. Consumer confidence, a crucial driver of economic growth, plummeted. Surveys revealed a deep pessimism among Americans about the future of the economy. The Conference Board's Consumer Confidence Index, a closely watched gauge of sentiment, fell to levels not seen since the Great Recession, indicating a high level of anxiety about the future. As Trump's second term progressed, it became increasingly clear that his economic policies were having a profound and potentially long-lasting impact on the US economy. While the full extent of these effects remained to be seen, certain trends emerged, offering clues about the future trajectory of the American economy. One of the most significant consequences of Trump's policies was the rise of economic nationalism. His America First agenda, characterized by protectionist trade policies and a retreat from globalization, resonated with a segment of the population that felt left behind by the globalized economy. However, this inward-looking approach came at a cost, leading to trade wars, supply chain disruptions, and increased costs for businesses and consumers alike. The erosion of trust in institutions, a hallmark of Trump's political style, also extended to the economic realm. His attacks on the Federal Reserve, his questioning of economic data, and his tendency to prioritize personal relationships over established norms created a climate of uncertainty and unpredictability that made it difficult for businesses to plan for the future. The long-term consequences of Trump's economic policies remained a subject of intense debate. Some argued that his policies, particularly his tax cuts and deregulation, would eventually lead to sustained economic growth. Others, however, warned that his protectionism, his attacks on institutions, and his disregard for expert advice would have lasting negative consequences, undermining America's global standing and jeopardizing its long-term economic prospects. As Trump's second term drew to a close, the US economy found itself at a crossroads. The president's unorthodox policies had left an indelible mark, reshaping the economic landscape in ways that were both profound and uncertain. The challenge for policymakers, business leaders, and ordinary citizens alike was to navigate the choppy waters of Trump's economic legacy and chart a course towards a more stable and prosperous future. The global economy, already grappling with the lingering effects of the pandemic and geopolitical tensions, faced renewed uncertainty in the wake of Trump's presidency. The rules-based international order, already under strain, had been further weakened by his America First agenda. The challenge for the US was to rebuild trust with its allies, re-engage with the global economy, and restore its position as a leader in promoting free trade and international cooperation. Domestically, the US faced the daunting task of addressing the economic inequalities that had fueled Trump's rise and continued to plague the nation. The pandemic had exacerbated these disparities, highlighting the fragility of the social safety net and the need for policies that promoted shared prosperity. The future of the US economy remained uncertain, shaped by a complex interplay of global trends, domestic policies, and the enduring legacy of Donald Trump's presidency. It was a future fraught with challenges, but also one that offered opportunities for renewal, innovation, and a more inclusive and sustainable economic model.
Well, pretty interesting stuff. Now, this is, information that you're not going to hear from your average pump and dump influencer. They don't want you to know what's actually happening in the real world. There's no doubt, though, that that little bug that was introduced from a leak from a lab, as has now been proven, caused severe economic damage to the entire world. And we are only just getting on top of it. It's taken decades off the economic growth of the planet. And at least Donald Trump is trying to do something to fix it. I mean, look, they are in a terrible mess. Over $36 trillion in debt. They hardly make enough money to pay the interest, let alone and everything else. So the little things that he's trying to do is absolutely necessary. And I think what that means is that the markets are going to continue to be choppy. They're continually going to go downwards until this economic event comes to fruition. Everybody understands what the play is, and then we'll just have to accept what goes on going forward. However, there is a bright spot in the world because all this liquidated money has to flow somewhere. And one of the places that it needs to flow is into Pulse Zen, because everybody now is looking for yield, and yield is very hard to find. But guess what? We knew it would be, and that's why we invented
The
this.
power of Pulse Zen is in the compounding interest code. Let's look at today's numbers. 1 million Pulse Zen at $0.0005. It would cost $500. The daily pay it forward code can average for the year 500 Pulse Zen per 1 million held. So you are making about 25 cents a day, or $91 or so a year. So that works out to a very nice 18.2% a year, no staking, no lockup. However, if we allow ourselves to imagine the growth in Pulse Zen, imagine daily volume increases, and price is 30 cents. Everything looks shockingly different. The daily PIF is now $120 a day, at 30 cents per Pulse Zen that generates compounding rewards of about $43,800 a year, which is a staggering 1,460% APY. Go see for yourself at pulsezen.app.
Now, these figures are real. We tested thousands of combinations of, the tax that was going to be applied to this coin, and this combination always came out on top. The more people realize that yield is the name of the game, the more people are going to come into Pulse Zen. Initially on Ethereum, but then Pulse Chain. If we can ever stop the FUD of Pulse Chain, that's where the growth is going to be later on. But with the Pectra upgrade about to become reality in another month's time, probably by the end of April, it's going to make Ethereum even cheaper, which will make it even more attractive to the masses. We're still working on a click fiat to Pulse Zen. We're still being thwarted by the authorities because even now, after all the flanneling, we don't have any clarity on crypto regulations, particularly in the United States. Unfortunately, although they are not the main player in crypto, everybody else seems to follow their lead. So we do have to get that sorted out. So I hope you've had an exciting week. I hope you realize the benefit of Pulse Zen and how it is going to become the de facto coin of Pulse Chain. It just has to be. And I wish you well in the future. I'm going to leave you with a little thought, though. When I became a Bitcoin Foundation member, I was so excited about how this was going to be the payment system of the people. No third-party involvement, pure self-custody, pure DeFi, not centralized at all. But unfortunately, it really was taken over. And I saw the two factions fighting. I saw Roger Ver becoming involved. He didn't create Bitcoin Cash, but he was a big proponent for it. And he's being penalized for that right now. So if you haven't done so already, I highly encourage you to go to the Roger Ver site and sign up to try and garner support for his pending court case, because it's just not warranted. And he's one of the guys. He's one of the main guys that should be exonerated from all of this mess. So I'm going to leave you with one thought of something that happened whilst I was there at the Bitcoin Foundation. And I put a link to the Bitcoin talk where everybody posted. And it's very interesting, that little thread. And I put the link in the bottom of the chat there. So you can go and check it out for yourself and you can try and work out what exactly happened. But I can tell you that Peter Todd was very much involved. And he even came out and said publicly that he was working for an intelligence agency. Why do that? And then why produce a video explaining that having a larger block size was going to be so detrimental to Bitcoin that you better not do it? Do you think that was him talking, or do you think he was being led by a certain organization to stop Bitcoin from becoming a payment system outside of their control and to stop being able to give yield to people, even though you were going to have to give your coins to a centralized exchange, which is not the idea of DeFi? I'd like you to watch this video. It was sponsored by Peter Todd. It's about 8 or 9 years old, and it was instrumental in changing everybody's mind that Bitcoin was never a payment system. It was a store of value. How can it possibly be a store of value when we've seen in the last couple of months Bitcoin price go from 110 back down to 75, roughly $1,000, 110 to $75,000? How is that a store of value? It is not. So I'm going to play this video. You make up your own mind. Lots of people ask me about who Satoshi Nakamoto is. The only thing I can tell you about that is just over there, I know for a fact that he sat on that beach. And that's all I'm going to say. So I'll love you and leave you. I've got to go for lunch now, so I don't have time for any questions. But I will show you this little video, which I think is really instrumental in actually destroying Bitcoin from being a payment system.
Bitcoin. It's our secure, inflation-proof, decentralized currency. You make a transaction and it gets published to the global Bitcoin network. Bitcoin nodes all around the world forward that information to each other. Until seconds later, the whole world knows about your transaction. Every node, even yours, validates the transaction and ensures it follows all the rules. Bitcoin has a built-in limit of 1 megabyte of data per block, or 7 transactions per second. The transaction then goes onto one blockchain. As you know, Bitcoin has become very popular. Unfortunately, supply and demand will cause fees to increase over time, which means small value transactions just won't be practical. The easy thing to do is just have everyone change their software to accept bigger blocks all at once. Fees would go down, but you will need an expensive data center to run a node, and you won't be able to do it anonymously. Mining pools will be forced to close due to rising costs and regulations. What's left are large, powerful and regulated pools controlling what transactions happen at all. Doesn't that look like banking today? This is not the Bitcoin we know and love. We have an alternative to increasing the block size: off-chain transactions. The block size stays the same, and mining stays decentralized. You'll still use the blockchain for large transactions. Small exchanges will be handled by payment processors, which means small purchases like your morning coffee don't clog the whole system up. We can use the very same cryptography that makes Bitcoin secure to audit off-chain payment systems, as well as effectively make it impossible to get away with fraud or theft. Imagine a plexiglass bank where you can easily observe the inner workings. Unlike the completely public blockchain where you can't pick who mines your transactions or who you trust to do validation, off-chain transactions can be both instant, truly private, and you have complete control over who to trust. What can you do to keep Bitcoin decentralized? If you're a miner, only mine at pools that support the block size limit and ask your pool to publicly say so. If you are a user, ignore anyone trying to change the Bitcoin software you use to increase the 1 megabyte block size, and tell people you transact with that you support keeping Bitcoin decentralized and out of the hands of the existing corporate system. Remember, Bitcoin is democratic, and the only way the block size can change is if we agree to let that happen.
Well, there you have it. Very, very interesting. And if you've not seen that before, that was sponsored by a 3-letter agency in the United States, which destroyed the payment system that was Bitcoin. Now, Bitcoin is nothing. There's never going to be any yield for Bitcoin. You have to then look at it as a gambling play. When do I get into the market? When do I get out? To do that, you're going to have to be informed every minute of the day about what is happening geopolitical wise, and it is a gamble. Surely it would be much easier just to buy into an opportunity like Paulsen, Paulsen being the ultimate choice, of course, and just take the interest when and as you need it. Anyway, I'm going to leave it there. I don't want to add more fuel to the fire, but there is particular evidence that this was the biggest psyops in history, and that's led to the position that we're in now. I'm Conrad Zen, the former Bitcoin Foundation member, and now evangelist for the opportunity that is Paulsen. Thank you very much, ladies and gentlemen, for listening in. I'm a little bit busy today, so the broadcast isn't as long as it probably should be. I'm no influencer, but I am absolutely committed to bringing the truth to the largest number of people that I possibly can. It's also up to you to try and explain the opportunity to other people if you're already in it. And if you are already in it, please know that buying and holding compound interest on steroids, as Berkshire Hathaway's Warren Buffett would say, is the greatest way to wealth ever conceived. It is the eighth wonder of the world. Thank you very much for listening, and wherever you are in the world, Slangy Bar. Thank you.